Hey, what's up, Archangel? Give me a few minutes here, man. I'm actually live, but nothing's on the screen. I'm actually about to start a Teams call and have a meeting with somebody. So I'm joining it now. Let's see. Well, looks like I have the stream open somewhere. There we go. I'm excited, Archangel. This is a follow-up conversation. Nice. Just go back to my hotel room, doing a week-long Bob Ross. Yo, that's crazy. TwitchCon changed your life, brother. I love that. Video clips. Hey, Jody. How are you, brother? Uh, ah,
Actually, we'll just get together. He lives 5 minutes from me, so.
I like
But
it.
he was road tripping all. He went on a cruise. He went down to Florida. He visited our cousin. So he was literally gone for a month. So I haven't seen him in a while.
All right. Hopefully, get to see him soon here. And then, just real quick, Jody, I am actually streaming. So if you're okay with it, can I have you on stream and our conversation be shared and all that stuff?
I can't tell you any of my secrets then. No, that's fine.
All right. Let me go ahead here. I'm gonna turn everything on. Boom. Okay. We are there. I am very little in my own screen there, but that is okay. So if you want to check it out, I'm actually on Twitch, and you'll be able to watch this video after if you want. So if there's anything that you forget that we talk about or anything, boom, you got the video proof of it.
I believe you.
All right, let me see here.
Uh,
All right, let me get one more thing set up on my side, and then we will be ready to roll.
yeah. Well, when you're ready, I did my homework last night,
I love it.
and to make you happy, I put it on a spreadsheet. So
Oh man, I dig that. Let me save this.
the
Okay.
engineer in me.
Yeah, I really appreciate that. That will make everything today a little bit easier. And then I'll go over some details. Sorry, let me just get everything pulled up. So just I think you kind of mentioned this before, but right, anything you don't want to be shared with the world, keep between us. And then yeah,
Understand?
all right. So let me do this, and then I am done. All right, and then if you're okay with it, Jody, I'm going to give a little background. Let the audience know that this is Jody here, and obviously Free Advice Guy. We spoke yesterday. We went over a bunch of different topics: 401k investments, just how to look at different money topics overall. Answered some of Jody's questions. But yesterday was more of, would you say, Jody, like information finding? We learned about your preferences, and then I talked a
Right.
bunch, but today we're actually here to take some action and do some of the stuff you wanted to do, like change investments in your 401k. And what else did you want to accomplish today?
I guess that's the major part. Just show you the budget that I put up. I think it's realistic, and so it's actually kind of you learn something when it might be in your head, and obviously you already know I live below my means, but uh, it's kind of surprising when you add the numbers up. It's definitely different on paper than in your head.
Oh yeah, it always is. A lot of people will misdiagnose their own budgets by like 20 to 25%. It's kind of wild, and that's why generally when formulating a budget, I tell people it's actually going to take about 3 months because, like for me personally, it always feels like every month there's like a random $500 that I wasn't accounting for. I account for them now,
Right.
but you know it'd be like, wow, I forgot my car insurance is due this month. Wow, that's like $1,200 that I wasn't expecting. Great. So yeah, but let me pull this up here. I got all our notes from yesterday too, Jody. I meant to send those to you. I'll send them to you after our conversation today. Cool. Alrighty. So, where would you like to begin today?
You want me to show you what I did for the budget? And
Oh
just
yeah.
go through that?
Let's do it.
Right. So let me share my screen. I guess we'll maximize that. So basically, I did everything as a per month average. So, and I used like my mortgage. I'm not paying that yet. I'm paying rent right now, but I figured I might as well put what it'll be. And actually, to tell you the truth, for the first 2 years, it won't even be $2,850 because for whatever reason, the place where I'm buying, which is a 55 and older community, you pay 2 years HOA up front. So I'll actually be paying 26 and change for the first 2 years. But
Okay.
for budget standpoints, I made it what it's going to be. That's what my mortgage with taxes and insurance and all that'll be.
All right.
Then I got
Eventually
my
that
car
payment
payment.
will come off, right?
The car payment will probably come off before I move in, but I figured just in case, like I'm ahead of it. I mean, technically I don't have to make a car payment till July because I've been paying double. Car insurance, I just took my bill and did it on a per month basis. Church is 10% of my month income. Charity is Compassion, Gary Sinise, and Sunday Morning Breakfast, which is a local shelter for homeless people. So between the three, I donate $150 a month.
I love that.
Electric bill, I guessed I upped it. I mean, right now my electric bill is typically like $120, but assuming I'm in house, it's going to be more. So I bumped that to $175. Water bill, I don't have one at the moment. I didn't realize, but I guess the apartment pays for it. I don't know. So I Googled and put the estimated Delaware water bill in. Groceries, I just estimated off of what I get everything from Walmart.com. Dinner bills, I do have to eat a lot, so that number is probably high, and probably will come down after I buy the house. But for now, it's somewhat realistic. Gas, I actually bumped because I don't drive that much because I work from home, but I think I'll be driving more once I get a house, so I bumped that number. Presents, I just took a guess. The standard of gift giving may go down after I buy a house. Entertainment, then again, it's a guess, but as we discussed yesterday, if these two items, if don't trump the items up here. So if I ever were to get in a situation, I would just reduce those because I don't live with debt. Prescription, I'm putting $200 a month right now. Part of my pay or my net pay, I do have an HSA account with $3,000 in there. So
Nice.
They take $127 a paycheck out. So right now, I just put all my prescriptions on the HSA. The $3,000 was the max I could do, which I'll spend $3,000. It's not a problem. So I just guesstimated what the balance would be.
Okay.
So that's my total expenses. I didn't put credit cards in there. I put that, credit cards are going to be presents, entertainment, prescription, food, and I literally pay my balances off every week. So there never is a credit card balance past a week.
Okay.
So, and as I told you before, I don't buy anything unless I can pay it off in 30 days.
Yeah. And it's got to be cool being your friend or family member because you have presents budgeted. I don't know too many people who have presents budget in there, but I do love that. That's that's pretty nice.
Well, I buy some. They get some expensive gifts. Now I don't know that it's going to stay at that level because, as I told you, I've been living cash rich and house poor, but that's going to change a little bit. So, while I was cash rich and house poor, they benefit my kids.
Yeah. All right. So we got your delta there. You got a almost 540, or let's call it 500 difference there. What are you doing with that 500 right now? Do you think, or will you be doing with that 500? Are you throwing it anywhere?
I try to put it in my American Express high yield savings account,
Okay.
which I would say I'm guesstimating this to be high because I already, I know I put certainly right now that I'm back to work full time from medical leave, I put more than $500 a month in my savings. But, and that's on top of the fact that my, net income or my gross income, I'm putting 16% of my gross, probably 14% of my net income is going to 401k and IRA. So I'm already, ideally I'd like to be at 20%, but I'm at 14, 15% that, I just never see it. It goes away. It's, taken out of my paycheck.
Okay.
So I am saving money, just not necessarily in my savings account.
All right. Well, I'm really glad you put this together, Jody, because I know we talked about things yesterday. We talked about your emergency fund, and that American Express account was kind of your emergency fund. Now that we actually have your expenses laid out in front of us, I actually think your emergency fund could be reduced dramatically. You're probably 30 plus thousand. And I'm a conservative guy. I think 12 months of emergency fund is where like everybody should be. I get people are like, nah, man, I'm not keeping 12 months of cash aside. That's crazy. I totally get people saying that. But you never know what's going to happen. COVID, I try to remind people lost their job for much longer than they thought with COVID, stuff like that. But
Right.
to do about 12 months and with your expenses being kind of inflated, that's about 88,000. If you were to have 88,000 to the side in an emergency fund, that would be a full year of expenses. So if you want, we can now talk about this extra 30 plus thousand. If you want to do something like adding a third bucket, like an investment account, so that you can maximize after-tax investments or returns.
Totally agree. That's quite frankly the reason I got involved with you, because let's say I don't know exactly what settlement's going to be, but this 120, 100 grand of it, 105, I don't know the exact number, is going to go towards my settlement in May. So that'll be gone. Well, not all gone, but significantly reduced.
Okay.
Then obviously the 401k money isn't changing, and I don't have this money yet, but I'm anticipated in the next 30 to 60 days, I will get, because all the paperwork is finally done. It's with the Delaware State, whatever account handles that. So,
and that will,
should be coming.
Whoops, sorry about that. And that will maximize your, you will replenish your emergency fund with the estate money, right? You're going to use that money for the, okay, just wanted to make sure that I was on the same page with you there. Okay.
Nope, not buying a new car. Right. I might want to, but
we're not going to do it. Cool. Just want to make sure. So that difference will be about 10,000. So you might have about 20 to 25,000 to start investing with above and beyond your emergency fund and the money for the down payment for the house. You'll have about just now 20 to 25,000, and that'll keep going up by about 500 or so per month while you're working.
Right. Yep.
Cool.
That is what I would like to do. And just on the liabilities, there's a good chance, though, it may come out of that 110. I may just pay the car off for that 12 grand, which will reduce my cash, but it'll also reduce my monthly, payments by $350. So,
yeah,
it's just I don't like monthly payments. So I had already planned to have it paid off, but I thought I was going to have my mom's estate money sooner than it actually turned out to be. So,
yeah.
And the mortgage, that hasn't started yet, but I'm including that in the monthly financials because it's coming.
Yeah. Okay. All right. So for a pivot point, we can either start talking investments for your 401k or this these like $25,000 that you want, or one thing that we will need to talk about eventually is in your retirement in about 6 to 7 years. If you get the 32 to 3600 of Social Security, you're now going to be looking at another, either 3,600 to $4,000 that you now have to pull out of your portfolio per month. And that's if we didn't lower expenses, right? And I know we're already talking about lowering the car payment and all that sort of stuff, but just kind of understanding that. And then Social Security was going to be your only income in retirement, right? There's no like pension or anything like that.
That is it. That and my 401k IRA accounts.
Okay. So, like, if we take it, let's just say that your car payment drops off, so we're more at like 7,000, and then let's just assume 3,600 for Social Security. So you'd have 3,400 per month that we would need to pull out. So if we multiply that by 12,
right. Also, I know you understand this, but like that's 10% of my income. When my income goes down, that's going to go down too.
Absolutely. Yes.
So,
but some of those
well,
things...
I'm just saying it could be significant. If I'm making 168 grand a year and that drops to $90,000 a year, that's a significant monthly decrease.
For sure. Church will go down, right? Because if you're doing it on on a tithing 10%, that'll come down based on your income. Maybe your presence comes down, entertainment comes down, but some of these other things will sit at their levels no matter what.
Yeah, or maybe go up. Taxes are going to go up on the mortgage. They're never going to come down.
True. Hopefully you'll pay significantly less income tax over that part of your life. But okay, so just real quick, if we assume, and it could come, like you said, it'll be less than this, but if we needed 40,000 out of the portfolio every year, we got about 7, and it's going to be more than this. I'm just pulling this number up right now, but in 6 years, you're assuming the markets do what they should do. You should be above where we are now, but that you're doing almost 5.5% at about 41,000 coming out of your portfolio of the 754,000. Right now, that's about 5.4% or almost 5.5% of your portfolio, which would be on the high side. Although you're going to be 70, but a lot of people like to look at a rule of thumb like I'm sure you've heard the 4% rule. Try not to pull out 4% of your overall portfolio or more than 4% per year. And if you do that, based on the returns that you get per year, your portfolio shouldn't deplete earlier than, say, 30 plus years or so.
Right.
So that's what we want.
I'm pretty sure I'm not living to 93.
I hope you do. I hope we get to celebrate your 100th birthday together, Jody. But I just want to put those numbers in front of you. But like you said, your expenses are going to come down likely in retirement. But just to have those things out there so you know they're there.
Right. I'm fairly conservative in regards to if I can't afford it, I don't buy it. And like I said, like the gifts and stuff like that, or going to dinner, it'll all be based on what I can do. Right now, I can afford to do it, so I do it. But if circumstances change, then I stop. So.
Yeah, can I share an example you gave me yesterday? It's kind of like a joke because I would like my audience to know this. So Jody was talking about this too, right? If his income changes, and this should be for everybody, the way he stated this yesterday was actually how everyone should look at it. You live your life based on what you have going on, but as any variables change, if you can adjust down, like variable spending is the way I would look at it, like Jody is doing, and Jody has talked about. And Jody, you were what, did you say 60% of your income before?
For 8 months last year, yeah.
Yeah, Jody. So for 8 months, Jody was at 60% of his normal income and didn't tap into his savings because he was able to adjust his expenses lower. When life throws these things at you, no matter who you are as an investor or just a human being, you got to be able to adjust those expenses down in the way that Jody did. And if you're able to do that with some flexibility, it'll make those stressful times in your life that much better. All right, you
I
want
will
to...
say, I'll tell your audience, I'm 63 and I live, as I told you, paycheck to paycheck, probably to my mid 50s. But the worst part of it all, as I said yesterday, nothing takes away your freedom more than debt. There is nothing better than, yeah, I'm going to have a mortgage, but other than that, my car will be paid off. I will live debt free. And that, like I said, I mean, like January, I bought an $8,000 watch, but I wouldn't have bought it if I didn't know I could pay it off at the end of the month. There's no way I would have bought it.
Yeah. You have a smart mind around your money and what you truly can afford and you can't afford. That's really what I gathered yesterday, Jody. So I wish more people had that. All right. So do you want to get into?
It took me a long time to learn.
Hey, but you got there. That's awesome. All right. So do you want to have some fun with investments, or where do you want to move to next?
That's fine. You want me to pull up principal or?
Yes. Let's do that.
Okay. Give me a second to find it. Too many screens, too many windows. Let's see here. And I got to remember my password. Okay, let me try another one.
And then before you pull it up on your screen, Jody, just make sure it's like anything you're comfortable with people seeing, right?
Yep. Yeah. It didn't like my password. Hang on. Because I have caps on. Yeah, you got to give me a second here. It's a two-stepper, so I got to wait for my code.
Yeah, take your time, Jody.
Let me just take a quick peek here.
I don't know what just happened to Microsoft Teams. Oh, there we go.
I'm just taking a quick peek. I don't think there's anything on there that's giving the ghost away, other than how to spell my name. Share.
That sounds beautiful, Archangel. That sounds beautiful. Oh man, why does it keep doing this?
All right, that's the page we were at.
All right.
Yesterday.
All right. Let's see here. Okay. So, and then we want to go to, was it planning and guidance? And we wanted to look at the funds, right? Go towards the top there, yeah. And see if we can get to funds.
Yeah.
We might have to do it on the account side. Like
yeah, I was going to say.
Yeah. Yeah, and then do investments. And then, just so everybody can take a look, let's do your investments summary. And then I can kind of talk about what we talked about yesterday, but so the audience can see what we're doing here. Do view investment details over to the left there.
Okay. Well, before I click that, so am I reading that right, that it's saying that I've earned 0.86%?
Since January, yeah. We have had a pretty wild couple months in the markets, but really the last like few weeks. So since January 1st, that's what that's looking like. Yeah, about 0.86%.
I know. My conservatism says I could have in my American Express count earning 3.8%.
Yeah, and we can definitely talk about that because there's a peace of mind that you need to have when it comes to your investments. And while stocks and bonds will generally give you a larger return over time with because they're attached to the markets, a money market or a high yield savings account, if you know you're going to be covered, is the right investment choice for some people. But we could talk about that stuff. I don't think that's probably right in your 401k because we do want as much growth as we can, but for
Right.
some other funds. But all right, so as we take a look at this right here, like that principal stable fund, to me kind of sounds like a money market. I could be wrong. Yeah, it's a short-term fixed income, which I think is money market. And then you have a Dodge and Cox income fund, a PIMCO income fund, an American Funds Balance Fund. So those three funds have a lot of income things within them, or income portions of the portfolio, be it bonds or stocks, depending on how they're invested. And then you have this large cap fund. So now, okay, boom. Now we get into the U.S. stock market, right? But the large cap fund likely has overlap with that American Funds Balanced Fund, as well
Right.
as that MFS Value R6 fund below it. And then let's scroll down a little bit more. What I wish this showed is the expenses on these funds. I wish that was listed here.
And like this one here, which,
Yeah,
as I told you, I know nothing about this stuff. I don't look at it, but for personal reasons, I don't want any of my money associated with BlackRock.
yeah, I feel that. All right, so real quick, if you just to give an example, if you down below about 5 or 6, there's one that says principal. Oh wait, that's large cap S&P 500 index. Oh wait, that is okay. So right click that and see if it'll let you. Yeah, open link in new tab. All right, and then let's open up at the very top is where it opened that new tab. There you go. All right, let's see if they give us the. Dude, this site's so weird. Do asset. Oh wait, no, not asset class description. Investment option profile. Over to the left.
Here?
Yeah. See what this gives us. There we go. All right. So do performance and expenses. All right. Total returns. KKK. Where is the expense ratio? Did I miss it? Oh, here we go. Scrolling.
Here it is.
All right, 0.02. That's actually not that's not bad at all. I'm glad to see that inside of your 401k. Perfect. But the one thing is, and actually we'll show this too. So one of the things we want to look at is lowering your cost. 500 index funds is almost always going to be less cost than say a balance fund, but we'll get into that in a sec. So we can close this window now, Jody. And then close that one as well. And we'll go back to your investment details. All right. But mostly what I wanted to point out is that if you scroll down through all of these, there's a bunch of overlap. Like right here is the mid cap S&P. I'm not sure what that is. Small cap S&P. Okay, so you have mid and small cap, Standard & Poor's, New World, Diversified, International. Okay, so you're broadly diversified, but you have a lot of overlap. The way I believe you should invest is owning the entire world stock and bond market at an allocation that makes sense based on your time horizon and risk tolerance. Do you have a differing opinion on how you should own the market?
No.
Okay. So if we do that,
I don't even know enough to be dangerous. So.
All right. So I would like to scroll up on these for me real quick, Jody? I just want to look at them one more time. Okay, that's good. American funds. And this is principal. Okay. Oh, there we go. All right. So let's go ahead and take a look at a couple things. Oh, the other thing we wanted to point out is that when we added all these up, you're about 67% stock, 33% bonds. When we went through the 1 through 5 scale for risk tolerance, 1 meaning you can't handle volatility at all, you'd like 0 return because you can't handle volatility, or a 5 that you enjoy the wild swings of the market, you put yourself somewhere between a 3 and 4. I think I felt more like a 3, right in that moderate space. But I think you and I both understand.
I agreed afterwards.
Yeah, but there's a give and take there, you know. So I think what we wanted to shoot at was at most 60% stock at this point, and that it would get less stock as you got closer to retirement. Possibly even 55% stock now, even though you do have a stomach. You don't really look at your portfolio, right? You said you went a couple of years without looking at it. It doesn't really stress you out. But when you look at it, it does stress you out if you see kind of the downward movements in the portfolio.
I mean, like it went from 532 to 522. That doesn't rock my world any. You know, if it went from 532 to 432, then yeah, that would rock my world, because at 63, it's tough to make up 100 grand.
All right. So. But let me get into the beauty of that if that happens, Jody, because this is the other thing that we talked about earlier today and yesterday, the fact that you're able to flex on your withdrawals. So the reason a balanced fund or a target retirement fund is effective, what it wants to do is lock you in. Let's just say it's 50% stock, 50% bonds. Right? And over time, stock's going to be going up in value, hopefully. But when you get too far out of balance, it's going to sell out of that top stock and buy some bonds, get you back to that 50-50. So it's going to keep locking in those gains, moving them over into bonds, putting you in more safe investments. But let's go over the other side. 2008 happens. Your portfolio of 50% stock loses 50% of its value. You'll see that means, Jody, like just to be blunt with you, 25% of your overall value of your portfolio, at least temporarily, gone in that instant, right? But like we talked about yesterday, and I think you understand, if you hold it over enough time, it should come back. But that's not actually, that part's great. But the beautiful part is actually something called rebalancing. I'm sure you've heard buy low, sell high. These target funds and these balanced funds, the reason they're so effective and the reason I'm a big fan of them, especially for people who don't want to be fiddling around, making trades and changes and stuff like that, and especially inside of a 401k, is that it will take advantage of what the market gives you for you. So if the market tanks, it'll take some of your bonds, right? Because then you'll be at 75% bonds, 25% stocks. So it's actually going to sell out of some of your bonds, which have been likely artificially pumped up and priced due to a flood to quality. People get freaked out about the stock market. They move their money into bonds, so we get an artificial bump in prices there. The stock market drops. Now you take some of those bonds and you buy stocks while they're low. Now, assuming the market comes back to where it was before, you will not only recoup everything you lost, you'll actually be well ahead because you rebalance and you bought shares of stock while they were lower. So the main thing that I would tell you is that during those times, and for anybody listening, during the downturn in the market, do nothing except maybe buy stock when it's low. But the biggest mistake that most people make is they go in, hey, I have 500,000 in my portfolio, and then they hear in the news or whatever that the market's tanking, so they log in. Well, now they're at 400,000, and they're like, oh no! So they do what's human nature, and they sell, right? They run away from fire. Humans run away from fire when it happens. So as the stock market tanks, our human nature is to get out, run. But big investors we'll just say big investors for now, do the opposite of what you and I generally tend to do, Jody. Right. When you and I are freaked out trying to sell, big investors are like, gimme, right? They want to buy. So the main thing that I would tell you is if that happens, reach out to me. We can have a conversation. but do nothing inside of the balance fund because it'll take advantage. Whereas
Right.
you do have some of these balance funds, which exactly what we talked about will happen inside of these funds. But for some of these, it won't. They're just going to ebb
Right.
and flow based on what the market does, which is
Right.
okay too. But I like taking advantage of it with the rebalancing.
Gotcha.
That was really long-winded, Jody. I threw a lot at you. What sort of thoughts or questions do you have there?
Nah, it makes sense to me. I'm like, I have an engineering background, so when you speak things like that, it's logical to me. It makes sense. So it was funny. I was telling you, I talked to my brother right before I talked to you. He's the Tesla guy. He's still saying, even at this price, he says, buy Tesla. It's going to go up to $400 by the end of next year. So, and I don't know. I may actually just, like, as you know, I could take 10 grand, and if I lost all 10 grand, it's not really going to rock my world. So I am a little bit curious to maybe just take 10 grand, buy stock, let it sit there and see what, I mean, separate from my 401k and all that stuff.
Yeah. Hey, I'm glad you brought this up, Jody. So I fully support things like this. You've said all the right things. You understand it's taking additional risk, right? You're putting it in a Tesla. It could go to zero. And like you said, if it goes to zero, okay, it's no skin off your back. But because of that gut feeling you have and the potential that you could see, 70, 80% returns in the next year and a half, I get why that would be enticing. As long as you weigh all those factors in, and like you said, that 10,000, this is for everybody. I guess I'm not talking directly to you here, Jody, because you know this, but if that 10,000 or whatever you want to put in Tesla won't affect you, but it's kind of fun and you might get some extra returns on it, I support things like that as long as the main financial picture is not going to be hurt. Like you said, it's not going to hurt you. So that could be a fun thing for you to track.
Like I said, I do worry about certain things, but at the same time, like I told you, I've learned whether I had $30,000 in the bank or $120,000 in the bank doesn't really change my life any. Because if I'm not going to spend either one of them, what's the difference? It's like I said, the only time it would be different is if I had a $100,000 problem come up, which is not statistically too probable. So
yeah, it's very true. It's very rare that they're that large. All right. So if we're in agreement, let's scroll down to the bottom. Because if you agree, and let's do change investments, if you agree with what we talked about here, Jody, we can likely get you into one fund. Right. And then we can decide invest contributions, move balances. All right, let's do move balances, and then we can figure out where to go from there. So by moving balances, you probably already understand this. Multiple investment options. I think we want to do the one on the right.
Multiple investment?
Yeah, let's do multiple investments.
Don't assume I know anything, because I'm not joking when I say I know nothing about this stuff.
Yeah. All right. So before we current. Okay, so that's your current. Desired amount must be equal to 100%. Because what we essentially want to do is move all of this to zero. Right. Can you hit clear all? Yeah, right there. Did that do anything? Doesn't look like it. Nope. Man.
Well, it looks like you want to have one fund at 100%.
Yes. So the reason for that, and actually, I guess before we go into that,
I think all you got to do is pick the fund, and I write 100 in there, and it.
Oh, these aren't your current funds. Oh, okay. These are all the funds available. I thought these were just your funds.
Well, I don't know, but
no, you're right.
We're at zero, so if I put 100 in there, I'm pretty sure that's going to go to 100.
Yeah, you are correct. All right, so let's scroll down here.
You have to decide which one you like.
Yes. So lifetime. So you're going to retire. Let's call it Okay, so this is where we want to make a decision, Jody. And we're not necessarily going to pick a target retirement fund just for the sake of this conversation. If we pick the target
Right.
retirement fund, right, you want to retire in 6 years. Most of them are baked into 5 year increments. So you'd either have to
Right.
pick 2030 or 2035. The difference would be about 5% more stock in a fund that is going to retire you later. Does that make sense? Because they think you have more time, so you
Right.
have more stock.
I
Um,
could live with the 5%.
all right, that
So
might
that
be
would
where
make
we
it
get to
like
that point five.
55.
Yes,
Right. Is it like 55, 45 at that point?
exactly. Yep.
That's fine.
Okay, so let's keep scrolling down. Yeah, I don't know if these. Just real quick, right click on the Principal Lifetime 2035 separate account. I don't know if that is a. Yeah, right click, open a new tab. Yeah, and I don't know if this is a do investment option profile. Oh, actually, no, do that one. Do that one. Okay, the investment seeks a total return consisting of long-term growth of capital and current income. Wait, scroll back up there. Sorry.
Oh,
Over to the right, I was reading the investment strategy. The investment operates as a target date fund. There we go. Okay, these are target date funds that invest according to an asset allocation strategy designed for investors, having a retirement investment goal. Perfect. Okay, this could be exactly what we're looking for. And I was looking for principal because that's who the account is through, and I imagine their target
yeah.
funds are going to be cheaper than someone else's target funds.
Right.
So,
So does that mean anything? 3 out of 5 stars?
I love Morningstar, but their ratings. Ooh, I got to be mindful here. Their ratings
The
are.
principal, they have to be somewhat tied with Morningstar because I was just on one of their webinars and they offer all the Morningstar stuff. I don't even know what it is, but I know they're certainly not competing. They're in together.
Okay. So what?
If that makes any sense.
Yes, what Morningstar is really doing, it's a reflective look at things. So even if it was a 5 star, that wouldn't tell me to do anything. What a 3 out of 5 tells me is it's chugging along, which is what you want a target retirement fund to do anyway.
Right.
So yeah, it's a middle of the pack fund, which is what I would expect. And we could talk about Morningstar, but generally, what you hear is like a joke in the industry is that funds that get 5 star Morningstar ratings 1 year are like the bottom performing the next year because people run to that 5 star rating. But
right.
All right, so
Gotcha.
all right, so just to look at these, this is what the returns have been doing over the last since inception, the last 10 years or so. But I actually want to look at the allocation before we do anything else. So let's scroll up. Let's see, go a little bit more. Do risk and ratings. It's probably going to be in holdings, but yeah. Okay, yeah, let's do holdings. There we go. Fixed income, some international. This doesn't really tell me. Okay. Will you put your mouse over the asset distribution? The blue bar. Does it give you an actual number when you put your mouse over it? Okay, U.S. stocks,
40.
50%. Okay,
Right.
do the orange. 31. Okay.
Bonds, 31%.
Green. Okay, so 18. And then what was the blue number again? I'm sorry.
50 essentially. So they're doing like 68%.
That's like where you are right now. So this fund
Yeah,
right now.
here's the individual numbers are listed here.
Oh, right there to the right. So yeah, that's a lot of stock, Jody.
Right.
Okay. Let's close this one. I'm a little bit surprised by the amount of stock, but I guess that's 10 years away. I guess that makes sense. Let's close this one. Let's do the 2030, which should be right above that one. There we go. We're going to be experts on how to use the principal page by the time we're done with this.
That's right. So you're at 43% stocks. Well,
Boom.
actually 59%.
This might be... How do you feel about this? This is 60. So this is going to come down in probably the next year or two, I would imagine. I don't see where it shows their progression as it gets more conservative. But this is about 5% more than we talked about. This is 60. So this would give you a little more risk, which could potentially increase your upside potential for your investments. But it absolutely increases your downside potential by having 5% more stock. So in the long run, historically, more stock has generally outperformed. There's no guarantee moving forward, obviously. But with this information, do you feel comfortable with 5% more stock? Or should we look at the 2025 one to get you kind of closer to that 55-45? Because that will adjust to 50-50 within the next couple of years.
And I think I'm fine with this one.
Okay. All right.
There's the performance numbers.
Yeah. That's weird. It has better performance numbers even though it has less stock. I'm going to have to wrap my brain around that. I guess it's just 5 years, so maybe bonds did something there. But all right, so before we move forward, what questions or things do you have about this fund?
I don't know anything to ask a question, so.
Okay, then let me point something out to you. Click on holdings for me.
We met through somebody that, as you know, I trust very much, and I know he wouldn't lead me down the wrong path. So his trust I have in you.
I dig it. He's a great man. All right, so look over to the left. You see these top 10 holdings?
Yep.
All right, let's go back to your page, which I believe is the transfer balance page. If you look at, maybe scroll up. See these funds? Oh, I guess the PIMCO, Dodge and Cox you won't see. Principal, no. All right, let's scroll to the bottom. Let's see what these other funds are. But you own some of these funds already. That's what I was trying to point out. You already own.
Yeah, but it's less than 0.01%.
Yes. What this will do is make it so your one fund cleans it up. See, all right, so boom. Now you're getting into like these other ones, this large cap S&P.
Right.
Right, okay, it's 18%, but it's inside of this other fund already. So this, the reason I like this other fund so much is it's a set it and forget it, right? You just let it ride. Right. You set it, you have your risk tolerance, your allocation you're comfortable with, and you let it ride. It'll rebalance for you, take advantage of the market for you, and you don't have to think about it. The one thing that people don't like about this, though, Jody, is they feel like it's real simple. Some people like seeing 8 funds in their portfolio for whatever reason.
Well, maybe I'm just a skeptic, but to me, like, my company pays for principal. It doesn't cost me anything. But they do offer services, as I told you, like to manage this, they want it $250 a month or something like that. Yeah. Well, to get me to buy, the more complicated they make it look, the more, where you're going to pick one. Now, I don't need to pay somebody $250 a month to pick one.
The one thing
so I think part of the complication is for them to be able to sell their service. And I don't mean it in a bad way. They're in business to make money.
Correct. I completely agree with you, right? They want to show you, because it is possible by having a bunch of individual pieces that you can, right, if one of those specific individual pieces tanks, you can take specific money and invest in that one specific thing. Some people like that. For me...
Yeah, but there's plenty here that are like 0.01%.
Yeah.
They could go up tenfold. It's not going to make a difference in my overall bucket at 0.01%. It's like at 0.01%, why is it even there?
Yes, completely agree. So if we do this, we pick the 2030, right? So just put 100 in that 2030 just to see what it does. We don't have to move forward yet. Perfect. I just want to scroll down one more and see what the rest of these lists of funds are, just in case. Wow, all the way out to 2070.
Yep.
Chip, yeah, okay. It's interesting that they offer all of these options for you inside of a 401k. A lot of 401ks are moving towards less options.
Right.
So, but there's a reason for that. Most people don't know what they're doing. Okay. All right, Jody. So before we move forward, how do you feel about this?
I'm good.
All right.
Now that I understand how it works with the checks and balances, and
Yes.
I understand it can go down, but I'm not retiring for another 7 years, so we got a little recovery time in there.
Yes, and then remember, Jody, what did I say? Retirement is the first day of retirement is your last day or your first day, right? We want to look at it as that's the first day of the rest of your life. We got to have the money last forever.
Right, and truthfully, as I told you, my hope is to remain full-time till I'm 67, and then I'm hoping they let me go part-time full-time at 32 hours till I'm 70. And if I'm still healthy and I happen to like my job, it doesn't even mean I'll necessarily retire at 7.
Yeah.
If I'm healthy. If I'm not, then obviously. But
true.
if I'm not healthy, my lifestyle isn't, not trying to be depressing, but if I'm not healthy and I'm not out and about, my lifestyle is going to become a lot simpler, obviously, which I can reduce my cost. So.
All right. Now, those are very good points, Jody. Before we move forward with this, the one thing I want to point out is the only reason I wouldn't choose a target retirement fund and just throw it in every single account that you have is tax efficiency. If you only had IRAs and 401ks, these target retirement funds or target date funds are beautiful. The thing is, they're just not tax efficient, but they're in a tax advantaged account inside of a 401k or an IRA. So it doesn't matter that they're tax efficient. You don't get taxed until you pull money out. Now,
well, the IRA, I pay the taxes already, don't I?
Is it a Roth or is it a traditional?
It's a Roth. I'm sorry.
Ooh,
it is.
Nice. Okay. It's still tax advantaged. So even if the investment itself is tax inefficient, the investment vehicle you're using, being the Roth, is efficient. It sort of supersedes anything about the investment itself.
I mean, most of it is like 9% of it is 401k and 4% of it is Roth IRA.
Yeah.
And I can move those. I mean, that's like the things I don't know. To be honest with you, I only opened the Roth because my brother-in-law, the one that's a multimillionaire, said I should open one. So I trust him. So I opened one. And, I wanted to increase my savings. So I figured rather than just dumping my 401k, I'd open the Roth, which is what I did. But, my company only matches up to 6% on the 401k. So I could reduce the 401k by 3% and add it to the Roth if I wanted to.
Interesting.
I believe.
Okay. The only thing I would caution you about... Oh, go ahead. I'm sorry.
No, I'm just saying that doesn't have to be done at the moment. That can be a future discussion.
Yeah. I think you're going to be fine with this. I just want to bring it up that to be able to make Roth contributions to, say, like an IRA, your 401k is different, but like an IRA, you got to be under a certain income level. But that's not what we're talking about. You're making these... You said a Roth 401k, right? Not a Roth IRA? Because it's inside of this principal account, right?
It's in principle, yes.
Okay, then yeah, you should be fine. Okay, so the real reason I bring all of this up is there's a strategy called asset location. So if you have a taxable account, a Roth IRA, a traditional IRA, and a 401k, you can actually set specific investments into specific account types to maximize their after-tax benefit in the long run. Now, the taxable account isn't going to be a large portion of what we're doing here for you, Jody, but even 25, 30 as it goes will skew it. So let's look at your whole portfolio holistically. If we know we want to sit at about, let's just say 60-40, if your taxable account is tax efficient, which is what your emergency fund account would be, or not emergency fund, your investable money inside an individual account. If we put that in a tax smart investment, it would be like a total stock market fund that pays very little dividends and it's mostly there for growth. That way, when you start selling, you're going to pay long-term capital gains rates. Whereas if we put a target retirement fund in that same account and just a taxable brokerage account in your name, every time that pays dividends, it counts towards your income for that year, your taxable income for that year. So we do not want that, right?
Right.
So we want to strategically place these things. All right. So that was really long-winded to say. If we're going to go down this path, Jody, and that $25,000 in a taxable account, we're going to be investing it. We may actually want to be more conservative in your 401k so that when we look at it as a total picture, that's when we get to your 60%. Because if we throw this fund inside of your 401k and your IRA, but then we have just a stock fund inside of your individual account, we're now going to be skewing your allocation drastically towards stocks. Does that make sense?
Right. Now, I would say in regards to what I do with my, we'll say, leftover cash after I get my mom's estate and I buy the house, it seems to me the logical thing is to proceed with what we just talked about, and then we can revisit it in June once I have the monies and decide how much I have, first of all, and adjust accordingly based on what you feel is best.
I love it. That absolutely works. So yeah, right now it'll stay in cash until you close. And then once we figure out how much you actually have, then we'll re-look at your overall picture, readjust. But for now, this one fund and both of your retirement accounts will set you up for the time being.
Right.
Perfect. All right. Sounds good to me, Jody. I think we're on the same page.
Yes, sir.
All right. So did you want to do this on the call with me, or did you want to wait until later to do it now that we know what we're doing?
Hey, let's see what happens. We'll click the button.
All right.
Figure if something goes wrong, I'd rather have you on the line anyway.
Ooh, look at how clean that gets. You go from 12 funds here to one? And the funny thing, here's the really funny thing, Jody. Everything you see on the left side is inside of that lifetime fund. Literally everything you see on the left side is in that lifetime fund. It's just at a different allocation.
Right.
All
Gotcha.
right. So if you feel good, let's scroll down to the bottom there. Hold on one sec. I think we have to, submit request. If you want to do it right now.
Yep.
Oh,
that's why we're doing it live.
Do you want to just... Okay, yes. This was going to be the next thing I wanted to get into. I would recommend yes. Because this will just make it so now when they take the money from your paycheck and invest it, it'll be invested in this one specific fund instead of spread out amongst the 12 funds that you have right now.
We're on it.
Let's go. All right. That feels...
So let me... I just want to go back to the... Where's my... maybe I just got to hit home. So is there a way for me...
Yes.
I
Click
used
on the
to...
Sorry, I'm
used to
assuming
give
you want
the
to
break...
see it, right?
No, I want to see the breakdown between the IRA, Roth, and the 401k.
Oh, yes. Okay. So click under maybe investments. Review all investment options. Yeah, see, personalize. You could do maybe investment details, and we'll see if it breaks it down. It does not look like it here.
See, the homepage before used to...
What if you did my accounts? Oh, here we go. Contribution summary.
They used to have a page that told you how much was 401k and how much was...
Yeah, they should definitely have it. Okay, so you're doing 4%
there it
into
is.
Roth, 9% into pre-tax. Okay.
Right. There you go. So it's...
Still not the contribution or the... Calculate your contribution.
No, but...
Click on contributions again.
Hang on 1 second. Oops, sorry. Just doing something in my head here. What? 631 plus 280. 911 times 24 paychecks a year. It's less than I thought. It's 21,864. Oh, and then I get 3% from. So it's like another $5,000 or $4,000 from matching contribution from the company. So
yeah, it's not bad. Right. I mean, you're getting a total of about 16% just into your 401k for retirement savings. That's
right.
It's pretty good overall. I generally like 20% as an overall savings rate, but you're doing other savings as well, so we could talk about that.
Yeah, there it is. The 1121 number times 24 divided by my salary, which is roughly that. Yeah, so that's like 16% at the moment.
Yeah, not bad. Okay, so...
All right. What did you want me to hit?
I wanted to find, because now I'm curious, I want to see if we can get the percentages of your contributions and how they line up. I know that's how it's set right now, but how they're set and how they've been can be different. Oh, there we go. Contribution totals by source. Roth, elective. Wow. You gotta... Oh, I guess that might not be all Roth. But if it is, that's a decent Roth balance there, Jody. In your overall 401k. Okay.
Means nothing to me.
Hey, it's good to know. Most people don't have that because, you know what, 1/4-ish of your overall retirements in Roth. That's pretty good. A lot of people don't have that. It's becoming more and more of a trend now. I think younger and younger people will have more and more in Roth.
Right.
But to have, 25%, is quite a bit.
Well, I ended up, as I told you, we were an ESOP company, so roughly $370,000 of that was when they bought out our stock, which was all money they supplied. That 370, I put nothing in. The delta between what I have now and 370 is my contributions plus gains.
Okay. Makes sense. All right. But there we found that there.
Mm-hmm.
All right. So do we feel good about your investments here?
Yep.
All right. What else is on your mind?
I think that's it. Like I said, I think we set this up. I go through settlement and buy the house in May, and then we reconvene in June to see how much money I have left and what to do with it versus just leaving it in American Express making 3.8%.
Yeah.
Because it'll probably, at the rate it's going, it'll be less than 3.8 by the time June comes.
That's true. If interest rates keep dropping, those guaranteed rates on high yield savings and money markets are going to keep dropping as well.
Yeah. Well, it was at like 4.3 when I started a year ago, September. So yeah, it's definitely dropped. It's almost 4.5%.
And I think, it's not controlled by the president, but I'm pretty sure Trump has talked about wanting the Fed to drop rates. So
right.
Whether or not that happens, I don't know, but we'll see, and we'll see what effect that has. But...
Well, I'm old enough to know that a mortgage rate of 6-7% is actually normal. And when we were at 2.9%, that was abnormal. In fact, my dad passed away and my mom passed away this summer. So we're cleaning out the house. And I found an old mortgage calculation book that was my dad's. So I kept it because it reminds me of my dad. Well, that mortgage calculation book, it starts at 6%.
Wow.
Because there was no mortgages below 6% back in the 80s. Well, actually, this book is probably from the late 60s. But my point is, it went from like, I think it went from 5% to a max of 12, because that's where mortgages were. I mean, and my poor brother, he bought a house in the 80s in Jersey. He paid almost 18% at that point. That's what mortgages were.
Yeah, that was a wild time. That was a wild time.
So these youngins that think, oh, I'm going to wait, I'm not going to buy a house till the mortgage is down to 3%. You can be waiting a long time before you'll ever see mortgage rates at 3%.
For sure. These last 20 years ish, right? I guess 17 years since the '08 crash has like warped people's minds. They think these last 18 years are normal, even though history says these have been like totally weird, out of normal years. So we'll see if we regress more towards the mean.
No, I think we're covered.
Cool. All right, Jody.
And
Well,
like I said, reconvene in June and find out what to do with the rest of my money.
Yes, sir. All right. Well, if anything comes up beforehand, Jody, you know how to reach me. Always happy to have another conversation.
Yep. Well, I appreciate all that you did.
I appreciate the conversation, Jody. Have a great day, sir.
All right. You too. Bye-bye.
Bye-bye. Whoo. Okay. Let me... I hope that all came through. I don't know if it did. Nowhere to run to, baby. Nowhere to hide. Boo, 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 boo. All right. All right. That might just be it for the stream today. We shall see. Hey, we got a decent amount of people on the TikTok here. How you doing, Trenton? I hope you enjoyed that there. If you have any questions about finances or anything like that, I'd be happy to discuss those with you. To give you some background, I've been a certified financial planner professional since 2014. I'm a financial advisor. I worked at Vanguard for over 13 years, and I quit my job to change the world and give free advice to the masses. So if you or anybody you know has financial questions or anything you want to cover, I'd love to go over them with you. So just let me know if you got anything. All right, Trenton is gone. I am going to call that a stream. Let me check one last thing here. All right. Uh oh. Kids are tripping. I'm going to be back. Bye, everybody.